never trade naked around earnings events. So the stock has such a big potential to move that when you're short these positions around the earnings event, you don't ever want to be naked.
Earning trades means fast movements, volatility crashes, the chance to make big money fast, but also to be hit by painful losses. So, what is the best way to do options trading with earnings? Well, I have a great guide. His name is Brad from North Carolina, and he's running the Facebook group Only Earnings. So, welcome, Brad.
Thank you, John. Nice. Thank you for having me.
I'm curious first, why are you attracted to earning trades?
Well, I like them because they're somewhat predictable in the sense that you always know in advance when the earnings event is going to be. So you should never be caught off guard by an earnings event. And you're only in the market for a very short amount of time. You're not exposing your whole portfolio for long periods of time. You're kind of in and out around the earnings event. And then you can, relax for a few weeks until the next quarter and come back and do it again.
We will dig into a few of the strategies that you are using, but I thought that first, tell us a little bit about yourself and yourself as a trader.
I'm not a finance person. I'm, I guess, a scientist, you could say. My background is all in biotechnology. I've been trading stocks and futures for about 25 years, but I only, I guess, somewhat recently, maybe about 7 or 8 years ago, really started to trade options. Somewhere around 2019 timeframe is when I learned about earnings trades. And I've just been really fascinated by earnings trades ever since then. And so that's pretty much my exclusive focus now is just on trading around earnings events.
So let's get into the earnings trades, and we have a slide here that maybe can help us understand how you profit from earnings. What are we looking at here?
Sure. So what we're looking at here on the x-axis or the horizontal axis is time. So wherever you see a time zero, which in this case is right in the middle, that is your earnings date. And what's being graphed on the y-axis or in the blue line is implied volatility or IV. This is essentially an average of about 300 different stocks over a 10-year period. You can see consistently what happens with IV as you get closer and closer to that T0 earnings date is that IV builds or increases as you get closer to earnings. Then when the earnings event comes out at T minus zero, you have what's called the earnings crush or the crush, where all of that comes out of your options. And so there's really two high level strategies that you can play for earnings. One is before earnings, where you're taking advantage of that rising implied volatility. And that's kind of shown on the left hand side of the chart. And then the other thing that people like to do is try and play the IV crush, where you'll maybe put on a short volatility trade right before earnings and then hold it through the earnings event and hopefully profit when all of that IV comes out of the options.
So we will dig into this, but first, why do we see this pattern with the implied volatility increasing before the earnings and then crushing like this?
Yeah, so I always like to think of it in terms of, when we're buying or selling options as retail traders, the people or group on the other side of us, market makers. We're not, trading against each other. And so if you're a market maker and you know when these earning events are, you are not going to be caught short these options positions because there's such a huge chance that these stocks can move such a great distance around earnings. And so what they have to do is almost artificially keep the prices of these options elevated going into earnings to kind of protect themselves. So what that's called is the implied move. So if you look at the, say, cost of a straddle as being the implied move, if you're a market maker, you're not going to sell that straddle right before earnings for really cheap because you're going to lose a lot of money if
Mm.
the stock moves a lot. And so what they have to do is kind of keep the prices of those straddles somewhat elevated, of the option positions, I should say, somewhat elevated going into the earnings. And so that's the effect that you see with the rising IV going into earnings. And then once the earnings event happens, the risk goes down a lot. And so all of that IV kind of comes out, and that's the IV crush piece.
So we will dig into the two types of earning trades that you were mentioning, and I guess we are starting with the short wall examples where you are taking an advantage of the crush of volatility.
Yeah, that's probably the most common way that people play earnings. And if you take an options class and they talk about earnings, I'd say 90% of the people are talking about short volatility trades around earnings.
How is that working? I think you have a slide you want to show here.
Yeah, please pull up the slides. Option Alpha is a big trading platform. They've launched a tool called Earnings Edge, where you can essentially backtest and filter a lot of these IV crush type earnings trades. And so I've been doing this for years, but about maybe 8 months ago, I decided to just kind of open a test $10,000 account on Tradier because they have a nice interface with them.
Mm,
And I started filtering for these sort of IV crush type trades. So what this slide shows is that we are looking at iron condors. So these are short iron condors where you're selling the inner legs and then you're buying the outer legs as protection, that have historically had a win rate of 70% or higher, and then a return to risk ratio of 70% or higher. So that's kind of my initial filter screen that I set up for these sort of hold through earnings trades.
mm,
Yeah. And on this slide, this is just an example of United Airlines, I believe, is the
mm,
stock. This shows a back test over, I believe it's a 3-year period. So that would be 12 earnings cycles, where if you put on this same iron condor, you would have had an 80% win rate and an average return of 108% trade. So that's why these sort of trades are really, really popular and powerful, because they do often have high win rates and you can make outsized returns, and you're only in the market for one day, which is kind of nice.
but they're not your favorite way of trading, I understand.
Well, yeah, so unfortunately, this is my live results. So I put on 123 of these iron condors. This is about over two different earnings cycles. And instead of getting a 80% or 70% win rate like the back test shows, my live win rate was only 45%. And my closed profit and loss was a negative $1,700, or roughly 17% drawdown. And the reason why I put this slide up here is because these are difficult strategies to stick with. So people will jump into earnings trades. They'll have 123 trades, haven't made any money, and then they give up and they go and follow the next strategy. The most important thing with these earnings trades is just getting in the maximum number of occurrences that you can, and ultimately the probabilities will play out, but they're not a high win rate trade. So you can have months, maybe even a year, of just losing trades, and that's really, really hard for people to stick with mentally, even though the math and the back test shows something different.
So let's move over to the long volatility trades then, the trades that you put on before the earnings. With the increasing IV, you should be pretty sure to make money, I guess, or not?
Not so fast, John. Nothing is that easy in options trading. So this is a slide here where we're just showing an example of that rising IV going into earnings. So again, on the x-axis at the bottom, those are your days before earnings, with zero there at the right, shown with the red vertical line. That's your earnings date. And so what this chart is showing is that, yes, on JP Morgan is the example here, you do have this consistent history of IV really rising and ramping up going into the earnings event. But a lesson that I think I've learned the hard way, and people learn the hard way, is that IV does not equal money. So there's other things, as you know, that go into the price of an option, mostly theta, and
Mm.
so they often offset each other. So here, even though we have rising IV, you'll see in the next example that usually theta can overpower that and you might not make money. Here we're talking about the price of a straddle. And
Mm.
so this is again, on the x-axis at the bottom, this is your days going to earnings. And as we can see with the thick black line, the
Mm.
median price of your straddle is actually going down. So even though that IV was ramping up and going up into earnings, the price of your straddle was decreasing. So the IV helps, it kind of boosts you up a little bit, but
Mm.
theta ends up overpowering here, and you end up losing money when you buy that long straddle, at least for JP Morgan.
And I guess that's what we see here, how you would actually lose money on those type
That's
of.
yeah. So this chart is actually showing what your returns would be. So on the left-hand vertical axis, that's the day that you would enter the straddle, and then on the horizontal axis at the top, those are your t minus zero all the way to the right. So what this is showing, kind of where my little marker is at the bottom right, is if you had bought a straddle on JP Morgan 3 days before earnings and then sold it at t minus zero right before earnings comes out, you would have actually lost a median of 3% return on the straddles. Some of them, yeah, maybe you got lucky and made money, but on average, you can see by the heat map, it's just not a profitable strategy on JP Morgan.
But I guess this is not a picture for all stocks, or is it?
No, it's not. So some stocks can actually hold their value a lot better than JP Morgan going into earnings. This is not my chart. This came from an academic paper published in 2013 where they looked at 300 different stocks going all the way back to 1996. And they say, what would happen if you had a delta neutral straddle? So every day they're hedging off their deltas to kind of, they don't want to see the effect of stock price movement. They just want to see if the IV is strong enough to make these straddles profitable. And what this shows is that most earnings quarters, so each one of those vertical lines that you see on the chart is a different earnings quarter, and you can see most of the time it was a profitable strategy. So just buying this random, it wasn't random in their case. I think it was like 300 of the largest companies. But if you just bought all of those straddles, that kind of on average, they made money. So this was kind of a big aha moment for me that maybe there's something there. Maybe this rising IV effect can actually be a profitable strategy. So again, this paper came out, gosh, 12 years ago now,
Mhm.
and the strategy still works today. So I've been running backtest almost every quarter, and you still see similar results now that we're even 12 years out of sample for this research.
Hmm. And
Yeah.
you have here is an example with the straddle on Nike.
Yeah, so Nike is a good example of a stock that tends to do better before earnings. So here we're looking at the price of the straddle. This is a delta neutral straddle, so it's almost not fair because we're not showing any benefit from price movement, which really helps when you're long a straddle. And then as it's showing in this thick black line is that the median decline is really low. So it's not losing its value that much. It's still losing value. So if you put on the straddle and the stock didn't move anywhere, you'd probably still lose a little bit of money, but it wouldn't be that much. But you have the benefit of if the stock actually does move, you can make a lot of money. So if you're going to put a straddle on at any time, what this tells me is that to maximize your chance of being profitable, a good time to put on a straddle is when you know that IV is going to ramp up, like here in this Nike example.
And we have a similar table as we had with JPM with much better results.
Yeah, so this is another heat map. This one looks a lot better. So anything that you see in dark red is good, basically. I'm looking at that far right hand column where it almost doesn't matter what day that you enter, that if you hold that straddle through to that very last day right before earnings, that this has been a profitable strategy for Nike.
How can you know which stocks would have this behavior of the straddle growing in value over the last few days?
Yeah, I wish I had a good answer for you, John, because then I would be a multimillionaire at this point. But
Mhm.
what I can tell you is that the same stocks tend to behave similarly for each earnings cycle. So we can get a clue just based on looking at backtest and historical data on which stocks tend to do better than others. Now, if you read some of the academic literature, there's some talk about maybe it has to do with the level of institutional ownership. So if you're a big hedge fund, if you're a big institution and you own Nike and you know that earnings are coming up, you might have to start to hedge your position. So you're going to start to buy some of these options going into the earnings event, and then the market makers, are going to increase the prices a little bit. So that's one theory, is that it depends on the level of institutional ownership. Sometimes you can look at past returns. So if a stock had a very huge outside move the last cycle, that's usually a good clue that the option prices are going to have to be a little bit more elevated the next cycle. So between some of all those different things, you can kind of build yourself a list or a watch list on what sort of stocks that you want to put straddles on before earnings.
Let's look at a couple of the trades you have done. We have an example here.
I took this screenshot a few days ago from a company called Infosys. And what you see here is a loss. And so sometimes I'll post things like this in my Facebook group, and I think I'm being very clever, and no one understands what I'm talking about, because I'm actually happy with the way that this is a strangle in this case looks. And what you can see by that pink line is that I'm losing money. I've lost, I can't see it right from here, say 200 and some dollars on this long strangle. But the other thing I highlighted in there is the negative theta. And the negative theta, I think it's $800 a day, is what this long strangle should cost me if it was not during earnings. So if I was long this strangle and it was not during an earnings period, I should be down like $800 or $1,600 at this point, because I was already in this trade for a few days, but I'm
Mm.
not. I'm only down $200. So that's just showing you the power of that rising IV. Yes,
Mm.
theta was a little bit stronger, and I lost money here, but that rising IV really offset a big chunk of that negative theta. So it gave me a shot of actually making money if that stock had actually moved on me.
Mm. And here's another example.
Yeah, so this is my favorite type of trade, because here the stock didn't move. So this is kind of like the worst case scenario when you buy a straddle, is the stock doesn't move on you. And normally what happens is you just kind of sink down into this valley of death as your negative theta kind of eats away at the position. But what you can see here is that the rising implied volatility here, it was actually more powerful than theta. So here it lifted my entire structure up above the zero line, meaning that at least when I took this screenshot, it was a risk-free trade. The stock could go up, the stock could go down, and I'm going to make money no matter what. So this doesn't happen all the time, but it does happen frequently enough that you can take advantage of this phenomenon. If you catch the kind of IV rise just right, you can put on almost what I like to call almost a risk-free straddle. It's not completely risk-free, but here, as long as the IV rises the way that it did, and you can get the trade on without really any risk at all.
In one way, this can be a bit complicated, right? To kind of measure this and see how this will play out. And some people just think like, okay, earnings. Very often the stock will just make a big move up or a big move down. So is that also a valid strategy to just do plain directional bets like buying a call or buying a put?
It's been very hard for me to try and pick direction, especially when you get a very short term, like some of these positions you're only open for a few days. So normally I would answer your question, no, I don't think you should be trying to guess direction. But I will say there is a phenomenon that's been measured for decades called pre-earnings stock drift, where
Mm.
stocks do tend to rise, especially in a bull market, going into earnings events, where people get very excited about it. They know there's a big earnings event coming up. Tesla would be a good example. If there was a big Tesla event coming up, you might see the stock kind of rise going into that. So I have seen people do things like, just long calls or long out of the money call calendars, where you can take advantage of both the rising IV going into earnings as well as whatever your bias is for that stock position. So if it's going up, you might want to buy a call. If it's going down, you might want to buy a put, for example.
Uh, I'm curious about your process for finding the stocks to trade on and choosing which strategy and which type of trade you would do. What is your process?
Yeah, so I mean I spend a lot of time back testing, so just looking at historical earnings moves, how options behave around earnings events. I have about, 700 different spreadsheets at this point. Um, just looking at that. And then I spend also a lot of time just kind of modeling implied volatility and its effects on these sort of complex structures. So that's what I find fun. I like to put these options into my spreadsheet and then say what happens if IV increases this much on this expiration and then it decreases a little bit on this expiration, then kind of see how that risk graph looks. And then once I do that, I can kind of build out a list of like a watch list of potential earnings trade candidates. And then I just have like a little reminder that kind of pops up when that right day before earnings is on the calendar, then I know I can go in and look at the trade on that day. And if it models well, I'll put it on.
You mentioned backtesting, and if any of those of you watching this now are curious about backtesting, we do have a video, an interview with Tammy Chambliss, where she's explaining how to get into backtesting if you haven't done it before. So I do recommend that video, and I will link it in the description below. So I'm curious about your risk management rules. What can you say about that?
The big one is I never trade naked around earnings events. So the stock has such a big potential to move that when you're short these positions around the earnings event, you don't ever want to be naked because that you just have that one huge loss that will blow out all your account. It's
Mm.
very, very risky. So just buy that, cheap little extra long protection, even though you might not need it 99% of the time. That 1% of the time you'll be very grateful that you had it. So that's the number one rule is you don't trade naked. Position sizing is very important. It's nice because most of my trades are debit trades, so it's very easy to position size because your risk is really the debit that you pay for that position. So a long straddle, if it costs me $100, I know that my risk is going to be $100, and so I tend to stick with about 5% max of my account size per position, especially for these long volatility trades, because there's really not much risk to them. So if you lose, it's hard to lose 100% for these like long straddles and stuff like that. You might lose 10 or 15% of the position. So using about a 5% of my total account size works well for me for these long volatility trades.
What are the common pitfalls or mistakes that you see people do?
Yeah, I mean, well, we already covered, trading naked, so that's an easy way to ruin your account right there. I think the hard one for a lot of people, myself included, is that because the win rate is relatively low, so say, less than 70%, it's a very hard strategy to stick with. I've seen people come in and you might trade months or 6 months and not make any money. And then so people, give up and they move on to the next thing. But for
Now
me,
we're talking about the straddle, long straddle.
yeah, yeah. So, well, both actually. So, both the long volatility, long straddle, long strangle, you can have low win rates, you can have low profit. So, for these long straddles, your average return might be, 10%. And so that doesn't sound like a lot for people, but the way to overcome that is just put on a lot of them. So, you want to get as many occurrences as you can.
What is the worst that can happen with a strategy like that?
Well, these certainly have the potential to lose 100% of your position size. So, especially because these stocks move around so much around earnings. If you're selling an iron condor, you can easily lose 100% of that. I had a calendar trade on a stock called EA, Electronic Arts, today. It went down 18% in one day. It wasn't even an earnings day, which is kind of frustrating. And so I lost 100% of that position instantly. And that's why position sizing is so important because it was only 3% of my account. Yes, I'm not happy about it, but I'm not going to lose any sleep over losing 3%.
And if you take this strategy and put on a, let's say, a risk profile scale from 1 being very low risk and 10 being very high risk, where would you put this long straddle strategy?
Yeah, I'd put it more on the low risk side. So it's, like I said, it's very hard to lose more than 10 or 15% of your position size per trade. You want the stock to move. So the best thing that can happen to you when you have a long straddle is that some big, crazy event happens and the stock moves, shoots up or shoots down.
Mm.
You kind of like, as opposed to selling zero DT iron condors or something like that. Here, you really want the stock to move, which is kind of fun. And so that makes it a lower risk trade. The worst that can happen is that you get, so the earnings date gets wrong, or somehow there's an IV crush because they release earnings early. But even then, you're only going to lose whatever you bought the trade for.
So you have been doing this type of trades for a long time. What are the results that you see, and how do you measure your trading results?
Yeah, for me, I'm really conservative, and this is not my core, let's just say, financial holdings. So, most of my portfolio is just in long equities, long stock. And so what I like about these earnings trades is that they're uncorrelated to that, and sometimes even negatively correlated. So I had my best earnings quarter during COVID. When my retirement account was down about 20%, my earnings account was up about an equal amount. So what I like to use this for is to really kind of offset that core holdings for me. So for me, I target anywhere around 20% a year, a very low risk, and I will stack that on top of my core holdings. Those
Mm.
people that do, 4 or 5 times better performance than that, but they're taking on more risk I'm willing to do.
How much time do you spend on this?
Not a lot these days. I have almost everything kind of automated, at least in my own spreadsheet. So I can log in, see what looks interesting, put my trades on, and get out in, maybe 30 minutes a day or so during the earnings season. The other nice thing about earnings is that, there's different quarters. And then so once you kind of wrap up a quarter, I can just take a break from options trading for, a couple weeks and go enjoy other parts of life.
So let's sum up these strategies. How would you do that?
Like everything in life, things with options are give and take. And so what we're trying to do here with these strategies is take advantage of rising IV, but we're paying a price for that, and that price is negative theta. It's really about balancing what you think the risks and returns are, um, for whatever your perspective or bias is on the market, and then choosing the best expected value trade per unit of risk that you can, and that's what options trading is.
For people who are curious about getting into earnings trades and feel that this would be an exciting way of trading, what would be a good way to learn?
Yeah, there's a book that I like. Brian Johnson is the author. I can't remember what it's called. I think it's Trading Options and Earnings or something like that. It's pretty technical, so I would not recommend it to any new traders, but I think he does a good job of summarizing that. Certainly our Only Earnings option group on Facebook is good. There's some backtesting services like Market Chameleon is a good one, and CML Viz, I believe it's called, let you go in and see historically how some of these different option strategies have done over earnings. And so that's where I spent a lot of my time just learning and looking at different positions and what works and what doesn't work.
And you do run a Facebook group where I guess people would also learn a bit.
Yeah, I do. So Only Earnings Facebook group. I am going to start a Discord. I'm not sure how active I'm going to be on it, but that's going to be at tradevega.com. And yeah, I just love trading earnings, talking about earnings trades. It's kind of my thing.
Brad, thank you very much for joining us and for sharing your knowledge.
Yeah, thank you for having me.